What if you woke up one day to find the financial world as you know it, turned upside down? That's a question many investors found themselves asking not too long ago. The day was Tuesday, a day that should have been like any other. But as the sun rose, so did the temperature of the inflation report. It was hotter than expected, and the financial world felt the heat. Stocks, those pillars of our financial skyline, experienced a significant drop. The skyline changed, and investors watched, their concerns growing as the numbers fell. The market, once a bustling city of opportunity, seemed to be facing a sudden winter. Yet, this was not a surprise to everyone. Wall Street strategists, those weathermen of the financial world, had been studying the patterns. They knew that after a prolonged period of upward movement, a pullback was natural. It was like the ebb and flow of the ocean tides, a rhythm as old as time itself. But as the day wore on, something remarkable happened. Amid the sell-off, investors stepped forward, ready to buy the dip. The S&P 500, a barometer of our financial climate, avoided a 2% daily drawdown. It was a sign that the market was not ready to surrender to the icy winds of inflation just yet. A Fed official even stepped in, downplaying the inflation reading. They pointed out that this did not change the underlying trend seen in inflation data. It was as if they were saying, yes, it's cold, but it's not the ice age. This reaction, this resilience was more than just an anomaly. It was a testament to the strength of the financial world. Despite the concerns about inflation, there were still reasons to hope. Earnings had been better than expected, and economic growth had remained resilient. It was a clear sign that even in the face of adversity, the financial world could still find a way to stand tall. Yet even in the face of adversity, the financial world continued to show signs of resilience. Resilience is not a word often associated with the stock market, but perhaps it should be. The financial world is a realm of highs and lows, of bull runs and bear markets, but amidst this constant ebb and flow, there exists an indomitable spirit of resilience that often goes unnoticed. Just a few days ago, the stocks experienced a significant drop due to a hotter-than-expected inflation report, causing concern among investors. The market trembled as inflation fears loomed large. But here's where the resilience of the market came to the fore. Wall Street strategists, the seasoned navigators of the financial seas, noted signs of strength amidst the turbulence. Despite the sell-off, they saw investors ready and willing to buy the dip. This resilience is not born out of naivety or blind optimism. It springs from a deep understanding of the market's dynamics. The strategists recognized the pullback as a natural occurrence after a prolonged period of upward movement. It was a moment of exhalation after a long breath in, not a signal of impending doom. And then there's the S&P 500, the benchmark index that measures the stock performance of 500 large companies listed on stock exchanges in the United States. This index, in its own way, demonstrated the market's resilience by avoiding a 2% daily drawdown. What does this tell us? It shows us that the market can weather storms. It can face challenges head-on and come out on the other side. It doesn't crumble at the first sign of trouble, but instead finds ways to adapt and recover. But resilience isn't just about surviving. It's about thriving, despite adversity. Resilience is about the market's ability to bounce back, to regain its footing after a stumble. It's about the investors who remain steadfast in their belief in the market's potential, who see a dip not as a catastrophe, but as an opportunity. In the face of uncertainty, the market held strong, refusing to bow to the pressure. It stood tall, a testament to its inherent resilience. The market's resilience is a beacon of hope in challenging times, a reminder that even in the face of adversity, there is always room for growth and recovery. It's a narrative of endurance, of strength in the face of adversity. It's a story of the market's unyielding spirit, its refusal to be beaten down. And that in itself is a story worth telling. Inflation, a word that can strike fear into the hearts of investors. Now let's delve into the impact of this economic phenomenon on our market outlook. When the inflation report came out hotter than the market anticipated, it sent ripples across Wall Street. The numbers were indeed surprising and caused investors to shift their bets on when the Federal Reserve, or the Fed, as we often call it, would cut interest rates. Now you might ask, why is this so important? Well, the interest rate is like the pulse of the economy. It affects everything from the cost of borrowing to how much you earn on your savings. So when the Fed alters this rate, it can cause significant shifts in the market. Before the inflation report, the markets were pricing in a 100% chance of a rate cut by the Fed's May meeting. However, the unexpected inflation data caused investors to reassess their predictions. Suddenly, the likelihood of a rate cut by May dropped to a 37% chance. The total number of cuts expected in the year also saw a decrease. But it wasn't just the inflation report that swayed the market's outlook. The Fed's stance played a significant role too. A Fed official downplayed the inflation reading, emphasizing that it didn't change the underlying inflation trend. This statement was like a soothing balm for the market's inflation-induced jitters, helping to bring some stability amidst the uncertainty. However, the market's reaction was more influenced by the inflation print than the Fed's stance. This shift indicates that investors are closely watching inflation trends and are ready to adjust their strategies accordingly. And so, as the dust settled, the market had adapted, reflecting the ever-changing financial landscape. This adaptability is what makes the financial world so fascinating and dynamic. It's a constant game of prediction, adjustment, and resilience. And that's what keeps us on our toes, always looking ahead to the next big thing. Amidst the turmoil, a glimmer of hope emerged. As the financial landscape faced the heat of inflation, an intriguing development took place. Earnings reports, often the make or break for many investments, started to roll in. And to the surprise of many observers, these reports were better than expected. Consider the context. We're in an environment where inflation concerns are high. It's a period of uncertainty where the slightest hint of negative information can send shares tumbling. In such a climate, positive earnings reports are like a breath of fresh air. They bring a sense of optimism, a feeling that despite the challenges, companies are finding ways to navigate and thrive. This isn't just about numbers on a balance sheet. It's a testament to the resilience of businesses and the economy as a whole. Against the backdrop of inflationary pressure, companies are still managing to exceed expectations. They're innovating, they're adapting, and they're delivering results. It's a clear demonstration of the resilience of economic growth. Economic growth, it's worth noting, has remained robust. Despite all the concerns about inflation and interest rates, the economy continues to grow. This is a critical point. It shows that while the financial markets may experience short-term fluctuations, the underlying strength of the economy remains intact. This resilience of the economy, this ability to withstand shocks and continue growing, is what's driving these better-than-expected earnings. It's a testament to the strength and adaptability of businesses, and it's a positive sign for investors. So, amidst the turmoil of inflation and interest rate concerns, a glimmer of hope emerged in the form of strong earnings reports. These reports have brought a sense of optimism to the markets, a feeling that even in the face of adversity, there's a way forward. And it's a reminder that in the world of finance, resilience is key. Even in the face of adversity, the market found a way to outperform expectations. This is the power of resilience. It's the ability to weather the storm and emerge stronger on the other side. And in the world of finance, it's a quality that's worth its weight in gold. The road to recovery is seldom smooth. The financial world is no exception. In recent times, we have seen a shifting landscape in the financial markets. The path to lower interest rates has been under careful scrutiny, as the Federal Reserve delicately balances the control of inflation with the need to sustain economic growth. This journey, however, is not a straight highway. Instead, it resembles a road filled with twists, turns, and bumps. The potential for a soft landing exists, but it's not guaranteed. A soft landing refers to a scenario where the economy slows down, but avoids a recession. It's an ideal situation, but the journey towards it can be fraught with volatility. This volatility is not necessarily a negative entity. It represents the natural ebb and flow of the market, the dance between fear and greed, risk and reward. In the face of rising inflation, the Federal Reserve has a tough job. If it raises interest rates too quickly, it risks stifling economic growth. But if it's too slow, inflation could spiral out of control. It's a difficult balancing act, and the market reacts to every move, every word, every hint of what's to come. This sensitive reaction can lead to price swings, creating a roller coaster ride for investors. However, we must remember that volatility, while unnerving, is a normal part of the market's behavior. It's the market's way of finding balance amidst changing conditions. And while it can lead to short-term losses, it also opens up opportunities for long-term gains. Savvy investors understand this. They know that the dips can be just as important as the highs, and that patience and resilience are key. The road ahead may be bumpy, but it's important to keep our eyes on the horizon, not just the potholes. The market has shown its resilience time and again. It has weathered storms and come out stronger. It has navigated through periods of uncertainty, and found its way back to growth. So as we look to the future, let's remember this. There will be challenges, there will be obstacles, there will be bumps along the way. But in the face of adversity, the market has shown its ability to adapt, to overcome, and to thrive. As we navigate the bumpy road ahead, let us remember the resilience of the market. Predictions are a tricky business, especially in the world of finance. But let's delve into some of the forecasts made by the experts. Oppenheimer's chief market strategist, John Stoltzfus, has made a bold prediction. He sees the S&P 500 gaining up to 28% this year. That's a significant leap, even by Wall Street standards. Stoltzfus's optimism is based on a few key assumptions. 1. He believes that the U.S. economy will continue to show resilience. Despite the hurdles we've faced, inflation, interest rate hikes, and global uncertainties, our economy has proven its tenacity time and again. 2. Stoltzfus is banking on the Federal Reserve's cautious approach to controlling inflation. The market has been more optimistic as inflation trends lower, indicating that the Fed's rate hikes have been effective. But it's not just about this year. Stoltzfus also sees the bull market stretching into 2024. He's looking at the bigger picture where recession odds are declining as inflation eases without a spike in unemployment, and GDP growth remains solid. This isn't blind optimism, it's a calculated prediction based on the current economic landscape and potential future trends. It's about seeing the strength in our economy, recognizing the power of resilience, and understanding the dynamics of the market. Of course, these predictions aren't guarantees. They're educated guesses based on available data and expert analysis, but they provide a glimmer of hope, a sense of direction, and a measure of confidence for investors. While the future is uncertain, it's clear that optimism remains a powerful force in the financial world. But not all are so optimistic. Some voices in the financial world are ringing the bells of caution. Among them, JP Morgan's chief global stock strategist, Dubravko Lakos, stands out. His view is that the rally in stocks, which has been the talk of the town, might have run its course for the year. He points to a number of headwinds which the economy is facing: declining fiscal and consumer spending, dwindling consumer savings, and the looming shadow of a recession in the U.S. economy. These factors, he believes, could put a damper on the optimistic outlook that many have been holding on to. His caution is not unfounded. A slowdown in spending can have a ripple effect across the economy. When consumers tighten their purse strings, businesses may see their profits decline. This could then lead to layoffs and an increase in unemployment. The domino effect continues, potentially leading to a recession. Lakos is not the only one voicing his concerns. His colleague at JP Morgan, Marko Kolanovic, is predicting a potential 15% drop in stocks, even in a mild downturn. This underlines the fact that the financial world is not a place for the faint-hearted. It's a world of highs and lows, with the potential for great rewards, but also significant risks. Investors are currently pricing in a 42% chance of the Fed raising rates in November, adding to the uncertainty. The New York Fed also forecasts a 66% chance of a recession by July 2024. These predictions may seem alarming, but they serve as a necessary reminder of the realities of the financial world. This is not to say that the situation is all doom and gloom, far from it, but it's a wake-up call to the fact that there are always two sides to every coin. While optimism can fuel growth and prosperity, caution can help to mitigate risk and prevent unnecessary losses. As we move forward, it's important to remember that caution can be as valuable as optimism in the financial world. It's a balancing act, and striking the right balance is key to navigating the turbulent waters of the financial markets. Resilience. It's a quality that can make all the difference in times of adversity. It's an attribute that's shared by both the people who weather the storms of life and the financial markets that ride out the ebbs and flows of the global economy. Let's look back at the topics we've covered today. We talked about the unsettling times we're living in, the upheaval and uncertainty that can rattle even the most seasoned investor. But we also spoke about the resilience of the market, its ability to bounce back even in the face of significant drops in stocks. It's a testament to the enduring strength of our financial systems and a beacon of hope in troubled times. We delved into the issue of inflation, a concern that's been looming large on the horizon. Yet despite the fear and apprehension, the market has shown signs of resilience. Even as inflation figures came in hotter than expected, causing a momentary stir among investors, the market held firm. It didn't crumble under the weight of these concerns. Instead, it adapted, adjusted, and marched on. We also explored the unexpected earnings surprise. Despite the challenges and uncertainties, many companies have reported better than expected earnings. This not only demonstrates the resilience of these businesses, but also serves as a reminder of the potential for growth and prosperity, even in tough times. As we look ahead, we see a bumpy road. Yes, the path to lower interest rates and a potential soft landing for the economy will likely be fraught with twists and turns. But the resilience we've seen so far gives us reason to be optimistic. It's a reminder that markets, like people, have an innate ability to recover and thrive in the face of adversity. We discussed the prediction of a continued bull market, a testament to the enduring optimism and resilience of investors. And yes, we also acknowledged the words of caution from those who warn of potential downturns. But in the grand scheme of things, these voices of caution serve as a reminder of the need for resilience, for the ability to weather the storms and emerge stronger on the other side. So here we are, at the end of our journey through recent financial events, a story of overcoming adversity. It's a narrative that's been woven with threads of resilience, a quality that has shown through in the face of significant drops in stocks, concerns about inflation, and predictions of a hard landing for the economy. In the end, it's not the challenges we face that define us, but how we rise to meet them. In the world of finance, that means resilience.